as that first debt is gone and that cash flow increases, you go, wait a minute, this process actually works. Like everything that I've been seeing on these videos, I'm actually seeing this real time in my checking account. How do we build that confidence? Like what are the actions we can take to be able to slowly step through shifting that anxious feeling to building more confidence around what velocity banking looks like? But I wanted to kind of hopefully go a little bit slower today to kind of talk through some of the different mental gymnastics it requires to be able to gain a line of credit, to be able to execute or eliminate debt. And you know me, I'm all for getting a line of credit, but I am not as concerned about the debt elimination. I understand the weight that it carries, and I do consider myself compassionate around the weight that people feel when they're having discussions with me around debt. But my ultimate focus is to assist in freeing up the cash flow, not just to pay off the debt, but it's an and conversation. Can we pay off debt and also put that money to work so it can work for you? And that's a much broader conversation. So this is absolutely about velocity banking. And you know, velocity banking is simply a strategy. And there's a lot of people on these, a lot of influencers out here who are talking about this strategy specifically. But it's a strategy designed to identify a debt tool so you can drive your income through it to be able to free up cash flow. Usually my question is, well, once the cash flow is freed up, what are you going to do with it? And today's story is, I'll call it very similar, but is so much focused on understanding leverage as a tool, understanding leverage as a vehicle to do other things. And it's not much of a tool unless you are taking action. So it's putting this line of credit into action so that you can do the things that you want. And in most cases, again, just for my people who may not understand what velocity banking is, in most cases, this is what we do. Income comes into our normal checking account, and then from our checking account, we pay our bills and our debts. And then what ends up happening is after all of these are paid for, that cash flow sits in our checking account waiting for something else to do. And sometimes that something else is taking trips or paying off more debt, or maybe it's even moved to savings. But ideally, it's once that income comes into our checking account and we pay those bills, that's it for that cash. That's a one-time use. And then what's left over hopefully is enough for us to be able to do other things. And in order to do velocity banking, you need to understand a few items. You know, what is that income? Where is it going? What are the total amount of bills and debts? And when I say debts, I don't mean the extra that we traditionally put on credit cards. You know, if the credit card balance is $1,000 and the monthly payment is $10, most of us are paying closer to $50 to $100. We're paying a little bit extra because the goal is to pay it off. When I ask, what are your debts? I'm asking, what are the minimums you're paying on those debts? And then, is there a debt tool? Have we identified a tool that we can drive income through? And we talk a lot about lines of credit, but there are many types of debt tools. There could be credit cards and other things like that, personal lines of credit, business line of credit. But in most cases, we're talking about some form of a HELOC, whether we're talking first or second position. And then obviously, what is your cash flow once we subtract the bills and expenses from the income? And as I mentioned, as we're doing velocity banking, it's that income is coming into your normal checking account, but from your checking account, we're driving it through some type of debt tool, some type of line of credit to be able to then pay bills as usual from that debt tool. And what happens with that leftover cash flow, instead of it sitting here in your checking account, it's actually sitting here on this line of credit. What ends up happening, and again, if we were to just simply step through that, when all of your income is sitting on your debt tool, it is satisfying the payment for that month. And in addition, it's that point in time where the balance on that line of credit is absolutely at its lowest. Once that cash flow is sitting on that debt tool, what does it do? It drops that balance on that line of credit. And as it drops the balance on that line of credit, that's the moment where we're paying the least amount of interest. And as we are paying bills from the line of credit, the balance is creeping up. But your cash flow is what ends up driving down the balance overall as it relates to that debt tool. So today's example is related to Ava. And this is a pretty interesting client that I've been working with over the last few months, I'd say. She's excited about the fact that, well, she was very excited when we first started because we started our conversation with, hey, I've got a $150,000 line of credit that I was just offered. My objective is to put this $150,000 to work so that I can pay off this debt that I have. I've got student loans. I've got some other things. I want to pay off this debt that I have and start building and generating wealth at some point. And so this is kind of the answer to the test before we actually walk through it. I rejected the fact that even though you have a $150,000 line of credit, I don't think it's something that we should be using. Is there an opportunity to go after something smaller? Why? Why if you came to me with a $150,000 line of credit, would I say something like that?
Right.
What's the value in, because again, I say this all the time. If you're going to offer me, if you're going to give me 100,000, I'm going to take that 100,000. Well, there was a few things that jumped out at me. One, she had never done velocity banking before. So she was just learning the strategy. That's number one. Number two, when I was looking at, and I'm going to walk these things through in detail, but as we were talking through the lines of credit, the cash flow that she has and the bills that she was wanting to pay off, I just didn't see the value in carrying a weight of 150,000. So moral of the story is we rejected that. We were able to actually become a family bank. As we were talking, she identified an opportunity to be able to assist her daughter. So here was an opportunity to actually become a family bank. And ultimately, she was able to crush her debt in about 30 months. And you'll see where I spend less time on how much time it takes to be able to crush this debt. But in truth, if we were to just focus on how long it takes to crush debt using the HELOC calculator, which we'll jump into, it took about 30 months to be able to do so. And a little bit more detail as it relates to Ava's specific situation. She's 57. She's got decent income, and I'll zoom in on this. She's got income around $46.65. That's her W-2 job. And she also has some rental income of about $1,600. So these two items added together, that's her income. And her cash flow at this point in time is somewhere around 1085, about $1,000 in cash flow at the moment. Again, if we were to just kind of focus in on her goal, her original goal, it's eliminate debt. I've got this line of credit, specifically 150,000, and I want to eliminate this debt. It's she does want to be able to provide some support to her daughter and maybe leverage some of this 150,000 to be able to do so. She was unsure as to how to go about it, so wanted to kind of dig into some of the details as to what that looks like. Because again, she's stepping through velocity banking and isn't as confident as one might be with a line of credit that size. And then cash flow optimization. Ava sought to optimize her cash flow ultimately so that she could do other things. You know, build, as your cash flow improves, what are those other factors that are improved along with it? Well, there's some things that when we talked, there were some pieces that I just wanted to take in mind. So as it relates to the HELOC itself, she was originally offered about 150,000 with about 9.4% interest on that 150,000. I thought that was kind of high, but in doing the math, I'd say it's anywhere from between 8 and 13 is kind of what I'm seeing at the moment. So the 9.4% after I kind of reassessed, that's kind of right in the middle of where most are. And again, after consulting with me, the idea was, hey, is there an opportunity to reduce this size so that the impact that you're carrying isn't so great? And again, I'll dig into some of the why, but it kind of jumps out here. The interest only or principal interest payment for 150,000 was going to be somewhere between $1,600 and $2,400 a month. What was her cash flow? Do you remember? Her cash flow was about 1,085. So if the cash flow is 1,085 and this line of credit that we're looking to pick up is somewhere around 1,500 to 2,400 as a principal and interest payment, my alarm was going off. Like, if her cash flow is greater at this stage, then I might be more inclined to move down the path of this 150,000. And for those of you who might be wondering, why couldn't I accept the 150,000, just not use all of it? I would say that is a viable and absolutely a response that I would have in a situation like this. And that is, maybe I'm offered the 150,000, but that doesn't mean I have to use it, because if I'm offered the 150,000, that $1,500 to $2,400 principal or interest only to principal interest payment is only based on me using all 150,000. So I do agree that that is an option. But the other piece that I didn't like, as I mentioned, was the 9.4% interest. So my question was, is there an opportunity to beat that interest rate, grab a smaller line of credit, and still accomplish the goal that you're wanting to accomplish?
Okay.
So emotional impact of financial decisions. So what I found interesting in this discussion is a lot of the, I'll call it, roller coaster of emotion being experienced is pretty normal. It was the initial anxiety around, hey, I've been watching you guys and I have an idea of velocity banking, but this is my first, I'll call it, true implementation of velocity banking. And so the concern was, whoa, this $150,000, yeah, it can solve a lot of my problems, but there's still some anxiety around this dollar amount in general. And how do we build that confidence? Like, what are the actions we can take to be able to slowly step through shifting that anxious feeling to building more confidence around what velocity banking looks like? And in doing so, we can actually achieve and or hit that financial piece. So it's that emotional roller coaster going from I'm anxious to this process. Now I'm stepping into this process. I'm starting to see what financial peace looks like. And then all of a sudden, I've got it. Like now it's on like gangbusters, right? I put myself in a position where I'm generating wealth, paying off debt, increasing my cash flow. So now I'm looking for a way to be able to put those put this dollar amount to work. So it's understanding what that impact is and how can we lessen this by going through this process. So how can we reduce some of that initial anxiety? Number one, by reducing the amount of line of credit that we're actually using.
Yeah, what's unfortunate is they can't see the pyramid. Yeah, you draw it in.
Is that what you want?
Yeah.
This is what we're doing today? I'm drawing today. All right, let's
Get your
draw.
crayons.
Let's do it. All right.
Oh, that's nice. There it is.
So, nice. You see what just happened there? So, the foundation of this process, again, the goal. What's the goal? The conversation started with, hey, I want to or am focused on eliminating debt. And so for most of us, the foundation of velocity banking is rooted in eliminating debt. And we talk a lot about the process being linear, meaning, hey, once I do this, then I do that, and then I move on to the other thing. So it always starts here, eliminating debt. I get it. But as we step through that elimination of debt, if this is the foundation that we're built on, as that first debt starts to become like, as that first debt is gone and the cash flow increases, you go, wait a minute, this process actually works. Like everything that I've been seeing on these videos, I'm actually seeing this real time in my checking account, which means you're starting to build that confidence around this process as your cash flow starts to improve. But as your cash flow starts to improve, what are some of the secondary benefits that occur as it relates to paying off debt? Well, isn't there an opportunity to go back to some of these credit card companies and increasing your credit limit? What happens? Well, it changes the ratio between the balance and the room available, so it improves your DTI. Well, in the process of improving your DTI, here comes the improvement to your credit score. And bottom line is, as your cash flow starts to take fold and increase, it puts you in a position to where now you can now qualify for more, I'll call it, interest-bearing vehicles at lower interest rates. So that 9.4% looks different when you start implementing these strategies and your credit profile starts to improve. And then the last piece is you're putting yourself on a path or putting yourself in a position to focus on what the true goal is. So it kind of starts here. This is just the foundation. And as we build upon these things while adding, while stepping through this process, our ultimate goal is freedom. What does freedom look like once that debt is paid off? Because again, you can be debt-free and broke at the same time. So what are those actions you're taking to achieve true financial freedom, not just paying off debt? So some of the challenges, and I'll just actually keep it large here. Some of the challenges as it relates to AVA. So yeah, okay, got it. So the home that we're referencing is worth about $400,000. The piece that I found interesting here is this home does not have a mortgage on it. So which means she doesn't have a mortgage payment that she's making, but she does have a HE loan. And this HE loan probably has about 29, 28 years left on it, something like that. It's a fairly new home equity loan. The home was paid off and she, I'll call it, fell into a product, not fully understanding the product that she was receiving. And I know my wife has a lot to say about home equity loans.
Sure do.
But the moral of the story is she picked up a home equity loan some years ago, and the balance on that home equity loan is about $136,000. I think it started out as $177,000. And what I believe she used the home equity loan to make improvements on the home, also pay off some other debts. But we're sitting here, meaning this is what's current. There's no mortgage on the property. There's only this home equity loan. The interest rate on that home equity loan is about 3.5%, so a fairly low interest rate. And I believe the payment on this home equity loan is about $1,200 a month. So from my perspective, and this is very easy for me to say, the monthly payment on this home equity loan, I didn't see it as super impactful, but I see why she wants to get rid of it, because what is the flexibility with her having this home equity loan? How about none? She used it and that's all she was able to do. And now she's got 30 years to pay it off. And sweetheart, if you want to jump in here, what is that impact of having that home equity loan? What does it do over time?
The thing about Ava, and we changed names, by the way, for anybody who's wondering, like, we're just putting somebody's business out here. We do change her name for privacy. The thing about Ava is that she got this before she even understood what it was. In her mind, she was just accessing her equity, and some of the marketing around these, even if you're scrolling on social media, some of the marketing says no payment, right? Oh, with a HELOC, you have a payment, but with a HE loan or HEA or HEI or HEO, whatever they're calling them.
EIEIO.
Yeah, you don't have a payment. So isn't this already better? This is why I chose. Half of these people doing these ads probably don't even have one. Who even knows if they own a home? They're just getting paid to do these ads. She didn't know what she was getting herself into. And that was one of her concerns, is once she realized what she had gotten herself into, now she wants to get out as fast as possible, because it's like a parasite that attaches itself to your home equity. So it's not just that they gave you access to your equity. They've also attached a very hungry parasite to your equity. That parasite keeps eating at percentages of your equity as the market changes, right? So what you owe them in order to get out of that is very similar to a title loan, like a car loan, right? Or a payday loan. The longer that you are with that lender, the worse it is for you. It's not just a simple loan or like a simple interest loan, like a credit card. It's also tied to market value. Depending on your area, that could be a very bad thing for you, especially if you're anywhere near California after everything that's happened. People are flocking out of there. And so some of those bordering states have seen some serious increase in their values. What does that mean for people who have had home equity loans? That means that what they would have to do to buy out a company like that is far more than somebody in a different state, right? And this is why it's beneficial for them. So no judgment that she already has one. It's just that now that she does have one, we got to help her get out of it. Right.
And that's the weight. That's part of the weight being carried, right? Like, what are the actions that we need to take to be able to eliminate this home equity loan? So I fully get that that's the goal, but watch the twist or the turn we take.